Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with John Butler with Lend and Borrow Trust Co. And he's James Turk's partner. And we're going to have a really great discussion today about precious metals and really the future of lending and how it pertains to the metals industry. And it's going to be a really exciting discussion because there's so many things happening here in the 21st century, all of the trends that we've been talking about here. But, obviously with the onset of cryptocurrencies and just the internet, we've been afforded so many new opportunities and people have been taking their angles in advancing the way we do business. And that's what I want to talk today with John about. So it's going to be a great discussion. John, thanks for coming on Crush the Street with me today.
Thank you very much, Kenneth.
John, I must start with this. It would appear, and anyone watching precious metals, there was a psychological floor that fell out from under both gold and silver yesterday. Silver going below 15 and gold going below $1,200. And again, that psychological floor was, I think, very important. I mean, I thought 1,300 was a very important psychological floor when gold went under that once again earlier this year after experiencing some pretty exciting optimism early in the year. So what are your thoughts on this currently and what we're seeing right now?
Well, I mean, round numbers do matter. I mean, we like to think that we're all, super rational and that we, make our investment decisions, our buy and sell decisions based on a far more elaborate and thoughtful and reasonable analysis. But at the end of the day, emotion always creeps into these sorts of decisions. And so round numbers, such as those you mentioned, 1,200 for gold, 15 for silver, can nevertheless be an indicator of sentiment. And in this case, of course, sentiment is bad, right? Precious metals have been suffering a substantial correction now, which has taken us to levels which, to be fair, I mean, they still fall within the ranges that we've seen over the past year or so of trading. So it's hard to conclude anything too meaningful about this. But it does sort of confirm that sentiment is poor. Now, that said, the numbers, of course, those round numbers are dollar numbers. And yes, the dollar is the world's dominant currency when it comes to trading gold and silver, and for that matter, commodities in general, and assets in general, as the dollar denominated asset market is so vast and is the benchmark for so many others. So we can't take that with a pinch of salt. And yet when you look at gold and silver in other currencies, and I'm not just talking about the emerging market currencies that are blowing up, such as the Turkish lira, the Venezuelan bolivar, and these things, but even other major currencies, the dollar is simply strong all around. This is at base a dollar strength story. It is not a gold and silver weakness story, and that's a very important observation to make.
Yeah. That's an interesting point. By what do we measure our wealth in? Do we measure it by the homes we own and how the homes are doing in relation to other things? But, that's an interesting point, because the dollar is the measuring stick and, people are not feeling good about precious metals going down. We had that excitement back in 2016 where gold was going up, and it really seemed like the end of the bear market. And maybe over the longer term, that was the end of the bear market, but it doesn't feel like the end because it was so quick to go up to 1350 or 1380, was it? And then for it to just kind of go back down quickly, and then for it to go back quickly again over 1300 to fall again, right when everyone had that confidence to re-enter the sector. It disappoints. And I think that sentiment, that beatdown that investors are getting, are going to make it even that much more difficult for people to believe in precious metals going forward. Even though, what you're saying is it's not that it's doing so bad. I mean, it's still holding up and the moves aren't that major on a percentage basis. But I guess just the way that it's traded has been difficult for investors, especially conventional investors who, start to see the optimism jump in for it to fall back down, right?
Oh, absolutely. And the other thing to point out is that, other factors equal, people expect gold in particular, to a lesser extent silver, to perform well in a risk-averse environment. And here you've got all this talk about emerging market crises when people start scratching their heads. But there are two things I will say about that. First of all, yes, fine, a handful of emerging markets may be trading quite poorly. And to be fair, you can include China in that. China's not been looking so great, and so that and that's hardly a small market anymore, right? So that's one thing to point out, is that the emerging markets are weak, yes, but the fact is, the U.S. stock market's doing just fine, and people look at that as a relative safe haven when it comes to stock markets generally. And they look at the dollar, holding up generally well, and basically just U.S. assets in general are simply outperforming because of perceptions that a lot of the world is in trouble. But of course, that implies that somehow the U.S. is decoupling from the rest of the world, that somehow the U.S. economy can go from strength to strength, the Fed can keep raising interest rates, the U.S. will keep adding jobs, unemployment will stay low, et cetera, that this can just continue indefinitely. And, regardless of what you think specifically about Trump's policies or the situation with U.S. businesses and investment and all of these things, the fact is, if you look at history, decoupling is a myth. It can occur for short periods of time, 6 months here, 9 months there. But when you step back and you take a slightly longer perspective, invariably the US is simply too integrated with the rest of the world and vice versa. And there's a really good historical parallel for what I think we're experiencing right now, and that is what occurs in 1997 and 98. Because in 1997, you had a general crisis move through Asia and take out a lot of the Asian economies. It took them into severe recessions and sent their currencies into a tailspin. And so the dollar got stronger and stronger and stronger. And that was true not only versus other currencies, but versus commodities generally. I mean, the price of oil at one point falls briefly, ever so briefly, into the single digits in 1998 as a result of the general selling pressure in just about everything that wasn't a dollar asset. It looks a little bit similar now. But if it does look a little bit similar now, and I think it does, then you have to ask the question, well, okay, then based on your historical example, John, 97, 98, what happens next? Well, what happens next is that eventually the U.S. recouples. This is what will happen in the fall of 98. The various crises will continue to escalate. Eventually, they will ensnare long-term capital management of a large U.S. hedge fund financed by the U.S. banks, and LTCM will go bankrupt. They will go bankrupt in a scale that threatens those U.S. banks that were financing their positions, and the Fed will have to step in and arrange for a rescue. And indeed, they will ease liquidity in order to do so, and the dollar will plummet. It will plummet nearly 20% in trade-weighted terms in 2 weeks. So when people wake up and realize the U.S. cannot decouple from the rest of the world, things can change very, very quickly. Now, that's not a prediction, it's an observation, and one that should get us thinking that maybe this period of dollar asset outperformance, including the dollar itself, has a limited lifespan.
Yeah, and even Trump's policies have been not so much for a strong dollar, but for a weak dollar policy, with China manipulating its currency, and doing things across these country borders here. This strong dollar environment is not really what he ran on. And I'm not sure that this was all perfectly calculated by him or whatever, but I think the effort that is intended to be made, at least by his administration, is not to have a strong dollar policy going forward. Although, because of the talk, the trade wars, the tariffs, and various things happening, the strong economy, the jobs that are being created, the billions of dollars entering the country, we are seeing that strong dollar, that investment come into the U.S. And it's just creating new variables and new things to think about when considering what to invest in.
Well, absolutely. And again, I don't want to turn this into a political discussion, but no one's a miracle worker, and Trump is kind of trying to have his cake and eat it too. On the one hand, yes, he has this American first attitude. He has this, this attitude that he's not going to settle for trade deals that he thinks are unfair. vis-a-vis the United States. And yet he also wants, and implies that he wants the Federal Reserve not to raise interest rates too much. He's given indications to that extent already. But if he starts to try and talk down the dollar, then other factors equal, the Fed will want to continue raising interest rates. So you can't really have your cake and eat it too. And he's trying, I guess perhaps you could say, simply to be a general economic cheerleader on all fronts, both in terms of the policies he's trying to advance on just the pure business and investment side, tax reform, whatever it is, but also on the international stage with respect to trade policy and the dollar policy and so on and so forth. So I guess he's just trying to do what he can where he can, even if at times you could say some of those efforts begin to contradict themselves, such as your position on the dollar on the one hand and your position on the Fed on the other. But the fact is that he has contributed to what can only be described as a volatile situation when it does come to international trade. Now, I'm not predicting that this is going to descend into a damaging trade war, but the risk of at least a period of elevated and escalating trade disputes, that I think is probably kind of baked in the cake. I think he's kind of unleashed a bit of opened a can of worms here, you might say, which could lead to a series of at least minor, if not major, trade disputes. And the problem with those is that they do increase the cost of doing business. Anyone who's involved in even a small business with some export or import exposures is well aware of just how disruptive that can be. And so I think that is something that is not yet fully priced into U.S. asset markets. I think the rest of the world has priced it in much, much more quickly because the analysts who cover emerging markets, they're much more aware of these sorts of things because they see the political risk come and go with respect to trade and investment policy on a regular basis. Whereas in the US, it's been a much, much more stable environment for a long, long time, with one president after another, more or less continuing the generally free trade policies of their predecessors. So I think perhaps there's just at least some. I don't want to say that people who analyze the U.S. asset markets are living in denial, but I think they simply have less experience trying to come to terms with this sort of risk. And I think the danger is that they learn the hard way when corporate profits maybe take a hit in future as a result of some of these trade disputes.
Yeah. And I'm not. It's not a matter of contradicting you or disagreeing with you. I definitely agree with you, but I guess the only thing that I'm open to is that there's a lot more going on. It's like three-dimensional chess that the president is playing, or I think he might be playing, with the way he's posturing himself and potentially getting other countries to concede on certain things, and then who knows how things will play out in the future. But I think there's a lot of posturing going on. I think there's a lot of, again, to use the word one more time, three-dimensional chess that's being played. And I'm open to the unintended consequences, because there are obviously the direct consequences that you're talking about, but maybe unintended consequences, maybe optimism that's building because of this, or the attraction of capital that might happen because of the leadership. And there's just a lot going on, even though I believe in those sound money Austrian economic principles, libertarian philosophies. I'm open to all that is going on, and I'm not 100% sure how it will play out. But having said that, let's move on. So peer-to-peer lending, I love it. This is new technology in a way. I mean, not really, but it's something that's become popularized over the last few years because of the internet. And it's exciting, and I invest in real estate. I've done, things with precious metals. I've done things with cryptocurrencies. And you guys have offered a way to lend and borrow using precious metals. And I've talked to James Turk about this, your partner in this. Please share with us what it is that your company does and how you are servicing the customers that go to you.
Well, yes. Well, I mean, James Turk is the founder of the Lend and Borrow Trust, and his vision is that he wants to see the peer-to-peer industry have at least one platform, which is the one that he has set up, which in a way goes back to the future. In a way, it's banking the way banking used to be. Once upon a time, there was almost nothing, there was almost no unsecured lending that took place. If you look at the history of banking actually evolves out of the history of pawnbroking. When you actually had to put up something of value as collateral against which you could then borrow funds, either short or long term. And so, modern banking, which we treat as a very unsecured sort of area when it comes to borrowing and lending, that's kind of the historical anomaly. And so James thought, well, okay, let's embrace this new peer-to-peer technology, and let's go ahead and offer people a value proposition which returns banking to its more sound money roots, where there is always some sort of physical collateral behind the lending. And of course, a mortgage is also a form of secured lending. The problem with mortgages, though, especially when it comes to peer-to-peer platforms, is that houses, of course, can be illiquid assets, especially if you get into a downturn when they can be very difficult to sell. And there's a lot of friction involved when it comes to things like foreclosures and the legals and the paperwork and everything else. And so when you assume that peer-to-peer, the whole point of peer-to-peer is to try and reduce friction in lending, to try and eliminate the banking middlemen, to try to eliminate the accountants, the lawyers, and all the others involved in securitizing mortgages and things of that nature, well, then guess what? You should fall back on what must be regarded as the ultimate liquid, global, essentially frictionless collateral, which is precious metals, physical allocated precious metals that can be liquidated in an instant if needed to make a lender whole on a loan that goes into a default, in which case, say, the borrower has missed an interest payment or some such. And so that's the vision. The vision is to to combine this cutting edge peer-to-peer technology, which is very elegant and in theory frictionless on the one hand, or relatively frictionless on the one hand, and to combine it with the elements of sound banking as it used to be centuries ago. That's the genius of the idea, and James deserves an awful lot of credit for having set up a company to do just that. And it's my job now to get this value proposition in front of the largest community possible of people that do own gold and silver and who would like to have the financial flexibility to borrow against it if needed, to raise liquidity for temporary purposes, or to perhaps simply to leverage up, to borrow against existing metal to acquire a little bit more. Nothing wrong with that in principle, as long as it's done prudently and conservatively. On the other hand is the lender, people who would like to be able to lend for very, very low risk, essentially no risk when you think about it, because the credit risk is all but eliminated when you over collateralize a loan, as we do. We do not allow loan to value ratios on the platform to fall below to rise above 100%. So the lender is always at least 100% covered. So the value proposition for the borrower is that they can borrow for a lower rate than they would just by going to the bank and getting a typical unsecured loan. And then for the lender, they can lend for lower risk than if they were lending to a comparable entity in a way that wasn't properly collateralized with precious metals. So really, it's only the banks that lose. The borrowers and lenders both win, the banks lose, and that is the value proposition that is common to both sides.
Yeah, that is amazing. And I remember when I first tried to go to the bank, I was going to put 50% down on the house I was purchasing. And I was, running a business. I didn't have all my paychecks were just transfers from the bank account to my personal bank account. It wasn't all done in a way that was, by the book. Wasn't a simple W-2 or 1099 that I handed the lender and they were able to input all my information. But I had, six-figure income. I had the ability to cover 50% down, but because they couldn't check the boxes in a way that they would be able to securitize the loan, this is what I learned, they couldn't take it, and it was a no-brainer for them considering how much money I was coming up with. I mean, they should pray that I default on that loan, that they received all of that money, and then they would have the 100% of that asset back. But because of the rules of the banking industry, their hands were tied, and I wasn't able to get what I was looking for either. So I definitely see the need for these opportunities to help the business community, just people in general, to transact, and that's a beautiful thing that you guys have been able to do there.
It's interesting that you mentioned businesses, because we, in fact, are able on our platform to arrange loans not only for individuals but for businesses. And in fact, we have one business here in the UK where we're based that maintains some of its liquidity in precious metals, and they chose to borrow against their metal in order to expand their operations and invest in particular, invest in new energy infrastructure. So they're actually going off the grid. They're developing their own in-house energy source to power their operations, and they're using the proceeds of borrowing against metal in order to do so. And I think that's such a great example. Here you have a real industry. It's an agricultural business, okay? A real industry borrowing against real assets at a comparably very low rate as a result, and using those proceeds to make their real industry and their real output that much more efficient. It's as far from the financialization of the modern economy as you can get, and I think it's a terrific example of how our platform can be used.
And so, talk to us about the fees on how this works. What's the process like for someone to go through this lend and borrow procedure? Where are the costs, and what can someone expect if they go through this?
Yes, well, I mean, to present it from the borrower's perspective, basically, if you do own gold and silver, you'll simply need to open an account with Lend and Borrow Trust, and then you'll need to move your gold and silver into one of our approved vaults. Now, we only work with the highest security, most highly reputable vaults in the world, and so we have a network of vaults, and so the metal will need to be in one of those vaults, but they're major vaults run by Brinks, Loomis, the household names. And then once the account's been opened with LBT and the metal has been moved, then then the borrower can make a proposal to borrow, or they can simply select from an existing offer to lend on the platform. And we normally have a range of offers to lend, not only in dollars, but also in other currencies. And then once they find a rate, or if they do find a rate that's attractive at which to borrow, then they go ahead and accept, and they pledge the metal against that, or so they pledge the metal for the specific loan terms. The maximum loan proceeds against silver will lend up to 65% by value on the platform, or against gold, 75%. And the reason why you can borrow a little bit more against your gold holdings is because gold is naturally less volatile than silver, and so the lender is receives a comparable amount of security, as it were, if you take a look at the historical volatility data of gold and silver prices. And so you pledge the metal, and you receive the proceeds, again, up to 65% of the metal value in silver, up to 75% of gold. And then you can take those proceeds, and in principle, you can do whatever you want. I mean, in some cases, people take the proceeds and they simply acquire more metal because they want more exposure to what they believe is an undervalued asset. In other cases, they can take the proceeds and plow them into a business, such as in the example I just gave, or they can take the proceeds and they can pay down expensive unsecured debt. We've had one or two clients go ahead and come to terms with what was some higher unsecured debt than they felt was prudent. And so they've effectively refinanced using their metal. So there are many, many different ways in which this can be done. And then when the loan matures, the metal is released, and the client can either choose to leave the metal where it is, that is in custody, with Lend Borrow Trust. Although Gold Money provides the custodial solution for us, we don't do it ourselves. It's Gold Money is sort of the custodial backend, and the money remains in one of those vaults, and then it's available. The metal remains in one of those vaults, and then it's available for future use. If you want to borrow against it in future, you can borrow against it in future. And in fact, more than one of our existing clients has already decided to roll over a previous loan. So you can use the facility repeatedly, kind of like a flexible line of credit, but it's a flexible line of secured credit against your collateral.
John, so what happens then when the precious metals are put up, is it fixed at whatever price that gold is at today? Let's say if we did a transaction today, or does it change as the price of gold moves? And do you ever go back to the borrower and ask for more if the price of gold
If
drops, or
yes,
how does that
beyond
work?
a certain point, yeah. In order to protect the lender and in order to enable the borrower to benefit from lower borrowing costs, we need to have a robust procedure to ensure that loan to value ratios can never climb above 100%. And so let's take a gold loan as an example. Let's say you borrow $100,000 against a gold holding, which would need to be in excess of that $100,000. You can only borrow up to 75%. So you need around 130,000 of gold in order to be able to borrow 100,000 against it. Okay, so however, if the price of gold declines by the full 25% of over collateralization, such that the loan to value ratio rises from 75% to 100%, we can't allow that to happen. So what will happen in the event the loan to value ratio rises to 85%, that is a 10% increase, 10 percentage point increase, then we will notify the borrower that they will need to either put up more gold collateral in order to allow the loan to continue as is, or they will, or they will effectively need to reduce and prepay some portion of the loan in order to bring the LTV back down to under 80%. So this is it's an automatic procedure to protect the lender, but that's what enables the borrower to benefit from the lower borrowing costs. So we constantly monitor on a daily basis. We monitor the market value of the collateral, either gold or silver, and in the event that these levels are reached, then we do inform the borrower, and they can make a decision then regarding how to proceed.
And now, is there any sort of protection to the upside if the price of metals, let's say, goes up by 50%? Is there any sort of reimbursement of that, or is that the benefit to the lender, as protection on their end, and the borrower just knows that that's his money, or that's his gold down the road, as long as he pays off the debt, he or she?
Yes, I think it's kind of the best of both worlds if precious metals are in a rising trend, because what the borrower will find is that their loan to value ratio is declining, and so if they want to, they can borrow even more, right? They can top it up if they want to. If the ratio declines from 75% down to 65 or 60%, if they want, they can borrow even more. Alternatively, they can simply rest assured that they have even a more over collateralization, so less likelihood they would ever need to put up additional collateral. And yes, the lender benefits because they also get the added security of seeing that the loan to value ratio is far below 100%. And yet they're receiving their interest income. So everybody benefits, both borrower and lender, in the event that the price of the metals rises. That said, the borrower benefits quite directly because they actually own the metal. And so yes, as you say, when the loan matures, they receive their metal back from being used as collateral at a value that's potentially considerably higher than it was when they made the original pledge. But the lender, in a way, also benefits from the security. And so what I would say is that it is, to be fair, on both sides, a value proposition that will naturally appeal more to people who think that precious metals in general are undervalued, as opposed to people who think that precious metals in general are overvalued. That is certainly the case.
All right, sir. Thank you so much for coming on crushthestreet.com. I think we had a really interesting discussion, and really kind of the development of, where things are going, and, in some ways, disruptions of the current financial system. I believe precious metals are, in fact, that. And it's a beautiful thing to really give the power to the people. And I believe that is what, we're striving to do. And again, I'm very grateful to the internet for all that it's provided to really connecting
Sure.
people, and all of the indirect consequences, positive consequences that we're seeing because of it. It's really going from a very centralized, controlled environment to a very decentralized environment where people have more freedom. And I think that's what all of this is affording us. So, John, if you would share some closing thoughts as we end this interview today.
Well, all I would say is that, thank you for the opportunity to speak with you today. And I do hope that your listeners have found the discussion interesting. It is certainly my personal opinion that precious metals prices are generally undervalued at present. But that, in a way, it's an ideal time to launch the sort of business that we're launching, because it's one that will enable both borrowers and lenders in the peer-to-peer world to benefit from, when we eventually do get into that precious metals price uptrend. There's a saying, right, that there was never a better time in U.S. history to start a business outside of the Great Depression. That is, the businesses that actually got started in the Great Depression, many of them end up doing extremely well because they were set up at a time when the underlying infrastructure and the potential client base, et cetera, just hadn't quite developed yet. And then, eventually you get into the roaring late 40s and 50s when a lot of these businesses will become the household names that they are today. So I'd like to think that when it comes to the peer-to-peer industry, we're going to experience a similar development over the coming years when we eventually get back into that metals uptrend.
Powerful thoughts there. John, thanks for coming on Crush the Street. Appreciate your time with us. Thanks again.
Oh, thank you very much, Kenneth.